behalf of my colleagues at Echelon, I'm very excited to welcome everyone to our discussion session today. We are very pleased to have Converge's CEO, Shaun Maine, who is well known to everyone on the call, along with the board chair, Thomas Volk, who, may not be personally known to everyone on the call, but his track record of success across CanCom and Dell and HP is well known to everyone on the call. In terms of the call itself, we thought we might first dive into organic growth prospects, and that pulls out managed services, then dive into the inorganic growth, and then perhaps move on to the general. So with that, Shaun, Thomas, we thank you and we welcome you to the call. Thank you for making the time. We look forward to your insights.
Thank you for having us.
Now, just to dive right in on the organic growth, people do focus rightly on the managed services. You do have aggressive targets out there, 200 million and 500 million. I thought perhaps, Shaun, maybe you could start us off talking about the foundation that you have in place, the leverage that you have in place with respect to some of the things you've done or announced with Google, IBM, and Exactly IT as a global support center.
Yeah, so Exactly IT was a key part for us in that we're moving all of our service desk people to Mexico, and it's important to have that cost base. It's about a third of what it would cost in the US, combined with that user experience. And that you have a lot of Indian outsourcers that if you're on a help desk call, you've been on for 2 hours and they finish their shift, you have to start over from scratch with someone else. We would never do that. This is where we say net promoter score is so important because, as I've learned from Thomas, the easiest people to sell managed services to are existing happy customers. So we look to over-service our customers. We've got net promoter score over 50, it's 51.2 right now. And the Exactly IT part, when we buy companies, some of our Texas people, but also PDS, we're moving a lot of those service desk people down into that group down there. That is now around 300 people. We'll view to try to grow that to a few thousand people. So that's one of the key ones. They also have German language skills because Mercedes is located locally in Mexico where they are. And so that's also supporting some of our managed services out of Germany. Around the specifics around iSeries, we have a very niche and specialized offering around iSeries hosting. It's an IBM that's the old AS400 and Mini platform, which worked really well in the day, that is no longer a relevant hardware platform, but people still have applications that run on it. Infor, which is the third largest ERP vendor in North America, has 1,600 customers on this that are looking to move to the cloud. Now, the main vendors don't have iSeries hosting, so we partnered exclusively with Google to be their iSeries hosting partner. What that means is the Google sales reps in both North America and in Europe are selling our iSeries hosting capability. What that allows us to do is have a new customer that we can upsell service desk. That means if the customer has a problem, is it Google, is it us, is it them? Managed network, making sure they have the same bandwidth between their inside their company and out to the public cloud providers and us. Managed security, making sure the same endpoint security devices that they have inside their network, whether it be Microsoft Sentinel and CrowdStrike, are the ones that are keeping the bad guys out from their traffic. And then managed end user. As we've moved to this whole work from anywhere model, supporting those end users become much more important. So what is unusual about us providing managed services is to have a channel that allows us to have other people selling our services and getting customers that we wouldn't have gotten otherwise. The other piece I'll mention is as we acquire these companies, they also come with managed services. In that we bought PDS, they had 239 million of gross historical revenue. 16 million of that was managed services, especially around healthcare. They've got their nurse help desk, which is similar to the way Rednet has teachers helping teachers in Germany, not with just IT, but how do you teach online when you're basically just thrown, Teams or Zoom and say, go teach. They're helping them with curriculum and how to do it. Well, we have a nurse help desk. And this is where PDS, with their healthcare customers, it was the same thing with nurses and doctors giving online care. They were just, hucked a browser and said, go for it. This is nurses helping nurses deliver healthcare in a HIPAA compliant manner. So these service offerings that we're building up, and healthcare and education, there's new managed services offerings that were not available pre-COVID, that now in these work from anywhere models that are, and really what Rednet's done, you see the managed services that they're generating around that sector will be heavily focused on that this year. Again, as you mentioned, our goal was to get to 100 million of run rate managed services by the end of last year, 200 by the end of this year, but $1 billion by the end of 2025. And so these expansion strategies, and again, yes, absolutely, some will come with acquisition, but I'm not going to pay 12 to 15 times for a managed service provider. If I can buy PDS for 5.8 times and get 16 million of managed services, then absolutely I'll get that. So we'll absolutely be building up. That won't all be organic. In fact, there will be chunks along the way that will be from the acquisition strategy, but we're very happy that our strategy, and Thomas demonstrated this so well at CanCom, of having hosting and then building up, layering on top of it, service desk, managed network, managed security, managed end user is the right strategy.
Thank you. And Thomas, could you talk perhaps to your experience at CanCom? Like, what sort of rule book do you have? What are the things to watch for? Where are the opportunities? And also the pitfalls?
So, and about the topic of managed services. So I think the number one goal in managed service has to be to service your customers with an outstanding performance, because that, first of all, remedies the risk of churn, but secondly, is the best source for profitable growth. If you have happy customers and you add more services, and they want more services from you, they actually come to you and ask you to pick things up because they can't do it by themselves anymore. We've seen that now recently also within Converge. There are customers who basically lost a couple people in their IT staff, and they said, well, we are not going to replace them. Can you pick that up and run this part for us as well in an area of network management, right? So that's important, that the number one goal is that you have happy customers and customers succeed with you. The number two element then obviously is to make it a scale and efficient in terms of your cost structure. Managed service at the end of the day is all about scaling cost, right? And that's where the money is. If you can, therefore, and this is what you do, what we did at Converge now very well, define kind of a service product catalog, which are your standard capability, like what Shaun said, around the network, around security, around end users, around data, etc. You put that out there and then make sure that customers repeatedly use the same services, then that is where the quality obviously goes up because you know what you're doing, but at the same time, you also make more margin because you scale better. And that's what managed services are critical, that you do that. The pitfalls in managed services are obviously, if you go out there and pick up managed service contracts from customers which have some unique requirements which you cannot scale and repeat, right? So that's where you have to be very careful about, that you don't end up in situations where you basically go to a customer and the customer says, can you run this for me? And you basically say, yes, sure. And then you have to do something which is very specific and something which you need to hire people for and scale. That's not that's really where the risk in managed services lies. And that's what I've seen at CanCom. At both sides, we had some managed services deals where you made huge margin, and some of them where you lost money because we had some of these contracts which are required to keep for people 24/7 there all the time, keep the service. And those services are typically also the worst quality services because you have a small group of people. If anyone leaves or if anyone falls sick or whatever, you cannot easily maintain the service. So those things are the pitfalls in managed service. You need to be very careful about that you don't end up there. I think here at Converge, the approach obviously is different. That with Exactly IT, there is a platform now, and obviously Mexico with the lower cost and the high service quality is a great starting point, but also the technology and the platform they are using to basically automate the whole managed service process, and therefore make sure everything is measurable and everything is controllable is key for us to bring all the customers on from acquisitions we are making and bringing that new level of quality to them. And we already see impact from customers who were not that happy before the acquisition, will actually give us great rating now. So that's going to be, I think, for the future, both the organic growth as well as the inorganic growth is going to be the key element to do a great job there. And I think we are very well set up to achieve the goal.
But Thomas, could you go and turn to your experience with CanCom, where you did make acquisitions and you were successful in ramping up the managed service component within those acquisitions? Can you talk to timelines of changing the mix and what an impact that did have on the margins of those units?
Yeah, so I think the example I can talk about, because it's public information, is what I did in the UK with CanCom, right? And because they sold that business, now all the data is out there, so I can talk about it. The other parts I cannot easily talk about. But what I did in the UK is exactly the same strategy as Shaun has started this and implemented this now with Converge in North America. Is I bought 3 companies that had between 3 and 7% EBITDA. One of them was has a major managed services part in there. And what I did then is I fully integrated, right? So I basically built one managed services organization out. The 2 others had a little bit, so I put it together. I built one sales team, one practice in network, one practice in security. I did exactly the same thing Shaun did here. And when I left CanCom, that business was growing very nicely. And they sold that business last year, 21, for over 400 million to Telefonica. And the EBITDA was 14%. Now, this is exactly what I think we can do at Converge as well. Is if you bring this business together and you align them in the go-to-market strategy, you bring all the technical resources together and you have no boundaries in terms of accessing those resources, and then you build the right processes and infrastructure to execute on it, there is a huge uplift in profitability, right? And the reason they got to 14% was because I left now 2 years ago. My last acquisition was in 19. They sold it in 21. They didn't buy any further companies there. So they didn't buy low like what we do right now, companies with low EBITDA, which always drops our EBITDA margin. And then you can see what the potential is if you don't add more acquisitions, what the potential is the organic business in terms of growth, but also in terms of profitability.
And when you gave the figure of a 14% margin, was that a blended margin or was that attributed to the managed services component of the business?
It was a blended margin of reselling and managed service. Obviously, managed services, they didn't publicly mention that number, but obviously that was at least a 25% EBITDA margin again.
Right. And then in terms of the revenue mix of those properties, would managed services have been taken from 10% to 25%, or can you give an idea of how that was able to progress in a relatively short time frame, actually?
Well, it must have grown faster. I knew we had, when I was there, we had organic growth of 20-30% in managed services, right? So, and we publicly stated that. So obviously, UK must have been on that trajectory to get to 40% EBITDA, fixed EBITDA margin, because the reselling business there is the same like everywhere else, right? You don't get a reselling and IT services business above 7-8% EBITDA. That's high, right? And so they must have been proportionally growing the managed service business much faster.
Okay. And before we move on to questions around the inorganic growth, I thought I might just open it up. If anyone had any questions they wanted to jump in related to managed services and organic growth prospects, please feel free to jump in, raise your hand. Cool. Okay. We will leave time for questions at the end, but with that, we'll jump over to the inorganic side of things. And I guess we'll start there with Shaun as well. On this one, could you discuss when you went over to Europe and the UK, the process that you took in terms of identifying targets and then screening, and where you might be in terms of your pipeline development and categorization?
So yeah, so last year we before we bought Rednet, we had Thomas, a woman named Doris Albiez had worked for Thomas at Dell. Before then, she'd worked at IBM, as well as Ingram. So she's very familiar with the channel. She has the same relationships with the channel that I do in North America. And so we started the German market. We looked at 80 companies. We picked 16 of kind of our shortlist, and we're working through 4 now. Obviously, Thomas is extremely well known there and has great experience as well further afield. Being in the UK myself, I think we're both familiar with the UK assets, but we've been going through across Europe that pipeline. As I mentioned at the end of our Q3 call, we've never had such a full pipeline, in that we've said publicly that we'll be growing our acquisition revenue by $1 billion per year Canadian for the next 3 years. 400 million in North America, 400 million euros in Europe. And we'll be probably north of that figure in the first half of this year as we go and execute the pipeline. We've done 2, now 3 so far, and you'd expect to see a bunch more both in North America and Europe. We're very well capitalized, thanks to our cash from operations, as well as the fundraisings that we've done to go and execute against that plan.
Thank you. And Thomas, could you perhaps give or discuss the seller's perceptions of Converge relative to other potential buyers in the marketplace? You know, in terms of there are local reputations or standards expected with Bechtel or with private equity purchasers in the marketplace, and how does Converge differ?
Sure. Well, yeah. So obviously, let's talk about private equities first. I think the private equities, and I just had a long call with a major fund yesterday again. They understand that there is a consolidation opportunity, a market opportunity to bring companies together and basically then cross-sell capabilities to customers. They just typically they don't have the knowledge how to do that, right? And that's when companies sell, or if a company is for sale, they talk to private equities, and the ones who go to private equities are typically people where the management wants to stay on and sees an uplift in what they are doing. Private equities usually succeed very well in the first acquisition they do, because they can make all these promises about buy and build to this management and then incentivize them to do it. But then the add-ons are typically much slower than what we are doing, because for the add-on companies, it's not so attractive to become part of this quite often. And secondly, the private equity process to buy and build is much slower than we are doing it, because they have to go through the internal processes all the time. And typically, for them, a buy and build is ending by adding 2-3 companies, and then they are done, right? Because then they typically having to think about how do I exit this again. And then after 2 years, they probably bought 2-3 companies, and then they are like, okay, now let's solidify this, validate the proposition, and see that we get our money back. So if sellers understand that and they are fine with that, and they want to basically make money through that process, that's where we typically don't compete, because we're not buying companies for short term, we are buying companies forever, right? So that's the key. So that differentiates already basically the type of sellers we penetrate and succeed with versus private equities. Secondly, then you talk about the Bechtlers or the computer centers, or these companies who also make acquisitions out there. Their acquisition strategy differs significantly from ours, because they typically don't integrate the management and the sales and the people. They integrate some back office, the ERP, they integrate some logistic processes, but that's pretty much it. And then if you get bought by them, you own your own P&L and you keep running your business, right? And then you try to see how you get along with the others and whether there is any deal you can work together. But typically, those companies are not set up to create synergies in front of the customers easily, because everybody has their own P&L and they basically have their own fees. And that's also different from companies who want to go and be bought by Bechtle, have a different motivation than companies who want to be bought by us, because they know that our strategy will give them the ability to sell more to their customers, to grow internationally, to have access to resources they didn't have before. So basically for them, the whole story of their business is changing towards becoming a more complete partner for their customers. And also it takes all the pressure they had before away from them, that they didn't have these capabilities, which when you are bought by private equity, you still don't have the capabilities you didn't have before. If you're bought by Bechtle, it's very hard to get access to those capabilities. And these are the people who we are interested in as well, right? We want to buy companies who see that opportunity, that they can bring more value to their customers, that as part of the team they can succeed better. And that's why I think it's very simple when we go out there and we look at targets, that quite often we have proprietary targets, because a lot of people know about us, especially in Europe. More and more companies know about us and they like our strategy, and we always hear them say, we don't want to be bought by Bechtle for these reasons. And these are the companies who we are looking at, because they are targets for us. And that's also, therefore, it is not like, we are going into deals and compete on price against Bechtle. It's more a philosophical and a cultural difference. What does the management and what does the seller want to accomplish with the business? And based on that, we clearly can differentiate pretty quickly whether a target is for us or for someone else.
With a track record of, I think it's 26 North American acquisitions, is pretty well known in the market in terms of your ability to extend payables, your ability to realize on vendor savings, your cross-revenue synergies. Can you talk to how those may come to play across Europe and the UK?
So for the first time ever, HP, Ingram, and IBM are giving us pan-European certifications. In the past, you had to put engineers in each country and have them get the certifications. And the reason they're doing this, beyond the fact that Thomas is a very big, well-known person, is the fact that they see how quickly we can roll out these programs for their new offerings in North America. And they don't, what's really stifling the expansion in Europe is these country structures where you have to go through each one of them and get funded separately in order to roll these programs out. And the vendors want to, like, whether it be an HPE offering, want to go cross, or even our Ansible or Red Hat offerings with IBM, run campaigns across Europe, or say across the DACH region in Germany, Austria, and Switzerland, the German-speaking regions. But these campaigns, they weren't structured to make this happen. And see, as Thomas talks about, you need to provide a consistent managed service if you've got data centers in Slough and Amsterdam and Frankfurt from one provider. It's the same thing with these various technologies that support these, that if it's CrowdStrike, that you want to roll them out together. And so this is something, our European headquarters is out of Ireland, that we're able to roll these programs out across Europe. And so that's a very new thing that this is the first time HP's ever doing this. Again, Thomas did run HP's worldwide sales, so his relationships certainly help.
Yeah, I know. If you put yourself into the large vendors' shoes, they obviously have worked with all these local resellers and try to basically have them represent them in front of their customers. And that was the typical approach from a product selling point of view. Now, whether it's HP with GreenLake, whether it is IBM and Red Hat or VMware, or whether the problem they have is that they bring new concepts and technologies into the market. And since they depend a lot on partners to reach the mid-market, they basically, country by country, partner by partner, they are trying to get these initiatives going. When you look at HP's GreenLake initiative, that's something which has started in 2018, 2019. And even up to today, less than half of the partners are representing them in front of the customer. Now, what we differentiate with is because we basically built the same concept in Europe as we built in North America, where we basically share the technical resources across countries and across sales teams. For us, it's much easier to go to an HP and say, okay, we run an initiative with you European-wide. You can rely on us. We'll bring this concept to all of our customers through our technology team. We certify the whole team. And that's, for them, winning time, winning competitive advantage, and it is less hassle to basically, and less resource to get the thing moving. And that's what they see as a benefit with the way we are structured. And the reason it hadn't done this before is that nobody is structured like we are as a partner for them in Europe, right? And that's why I think you will see IBM, HP, and then others will follow when they see what we are doing. Will see us basically working closely together with them to ramp up their new initiatives into Europe, into the mid-market.
Okay. Could you talk perhaps to some of the valuation parameters that you were seeing in the marketplace, how they may range with scale, how they may have been moving in the marketplace?
So we've always been the kind of cheapest buyer out there, in that I'm buying companies that no one else wants in hardware resellers. As we mentioned, guys like Cognizant will buy a reseller with 10% Microsoft sales for 9 to 10 times. I'll buy a hardware only sale for the customers for 5 times. Now, when we went and meet platform companies, of course, like with Rednet, who had exceptional growth, a great management team in cloud, then we ended up bidding against 31 private equity people. And the same thing, there's very few platform companies. There's a heck of a lot of more of the lifestyle businesses growing at low single digit with great customers from owners that have been around for 25 years that have been basically using the cash generated to fund their lifestyle, that now are feeling threatened because people are coming into their customers with capabilities around cloud or analytics or cyber or managed services that they don't have. So that's why they need to move. And so for those companies, like for a Rednet, we then can buy these ones with great customers in different federated states in Germany that will extend her education offerings to those places, but I can pay 5 to 6 times for those. So again, the UK, the first one will be more expensive. And then after that, you can buy the ones that you're just land grab on customers, because I'm not buying the management team or cloud or growth. And so I think that's the kind of mix that we've shown so well in North America. Phase 1 was different from phase 2 and 3, but now we're able to buy say even larger ones like PDS for 5.8 times, even though it included 16 million of managed services revenue, is a great price for a company with some great healthcare customers, and larger. The one thing I'll say is if they're over 200 million in size, you're going to get less on the rebate uplift. I think our math people are very well familiar with. You kind of go to 3 to 4.5% off of volume rebates. With the larger ones, it'll be like 0.75 because they were top tier on like HP and Dell, but not IBM and Cisco. And so there'll be some other large ones that you'll say that's where you won't get the same uplift there. You might get more on the cost out because they've got more management teams, but that's the kind of the dynamic in the larger ones that once they get above 200 million.
Can you talk to how the pandemic, supply chain issues, geopolitical issues may have impacted either the supply or the valuations that you're seeing in the marketplace?
So on the supply chain issues really were last Q3 was the time when the manufacturing plants for certain vendors, so IBM and NetApp were never affected, but and then HP and Cisco have been most affected, but Dell and Apple, who used to have good supply chains, even they were impacted. And what it meant was plants were running at under 60%. So usually something that you would go when you receive an order from a customer that would take 4 to 6 weeks to deliver, it was taking 4 to 6 months. In Q4, their plants were back over 80% manufacturing, but the demand was so high, the backlog even grew. What we're seeing now is, especially with some of the ones like Apple and Dell, it's going down from 4 to 6 months now to 2 to 3 months. So you're starting to see that normalize. And again, you've never had problems with some of them. You still have those issues though with people like Cisco. If you're going to order a router today, it's going to be at least a June delivery date. If you're a smaller partner, it could be actually August. And HP is a little bit better than Cisco is. So it's not all the vendors. So what you will see is the unwinding of some of that backlog in Q1, Q2, and Q3, unless like I thought the pandemic was bad enough, and then we've got Russia invading Ukraine. Now that so far that hasn't had an impact. Thomas and I were just talking a couple of days ago about in Europe, most of our customers around education and healthcare is government funded, and therefore we don't think we'll see an impact there, and we haven't seen any impact so far in the U.S. But I don't know. But if no new event happens, I don't see that. I don't see it really impacting our the IT business so far. As far as how this impacts, buyers, well, a lot of the leverage models we were seeing even before the invasion of Russia of Ukraine were, as the interest rates rise, the private equity models of being levered 4 to 6 times to buy some of these targets, they're not able to do as much. And so we saw, and this is a case study of a deal in the UK where it was a private equity buyer that pulled out because they couldn't use the same model. And so what is happening? How does that impact? And again, that's more for the platform companies because private equity are going for them. Normally, we don't compete with those guys. So to our normal bread and butter, I don't think it'll change the valuation side. To the platforms, I think it might make them more attractive or have less kind of buyers for those kind of things. And again, we're really fortunate that we're so well capitalized. Again, we exited Q4 with $250 million in cash. We used $66 million on PDS, and we have a clean credit line of $300 million. So we've got a lot of spare powder to go and execute against this pipeline of acquisitions that we have.
Now, would I be too optimistic if I were to submit that the end customer, having gone through these difficult times, may be more inclined to deal with a larger provider such as yourself? Or also, if I was a smaller IT services provider, might I be a little bit encouraged to sell?
And so the big problem we hear constantly the stories of like some of the ones that are in our pipeline now that said, oh, shoot, around this managed services concept, I need $2 million of insurance. I don't have that. Oh, like we need to close really quickly. So we take care of that. Or, you need to be able to service, as Thomas was saying, multiple countries, and they don't have a geographical presence in these other places for, say, managed services. So there's constant, even what they're able to sell, like the salespeople like this, we have the best data analytics practice into mid-market in North America. We win the IBM Analytics Award every year, 85 data scientists with the broadest capabilities. These are capabilities that VARs do not have. And so when you have access to that kind of talent and in cybersecurity and in cloud and managed services, these are not things a VAR has. So their access to the capabilities as well as just size and scale, the campaigns that we're running with, the workshops around Ansible and OpenShift, which are Red Hat's Kubernetes and management platform that we go city to city, all funded by Red Hat or funded by VMware for the same thing. But these fundings, before we bought these companies, they didn't get rebates, they didn't get MDF funds, they didn't receive any of these because they were a small regional player. It was funny, one of even the targets talked about how the vendors, because you represent so much spend, you are so much more important to them. So size absolutely matters. Even if you look at terms, we started off with Ingram with 60-day terms. Then it was 60-day terms and 70 on IBM. Now it's 75-day terms. As you get bigger and bigger, you have more asks and you become more important and strategic. The fact that they're going pan-European on certifications, that's because we'll get bigger than Softcat this year. We'll be bigger than CanCom next year. Our growth model of organic and inorganic growth, no one can touch in the industry. It's a wonderful model.
Could I ask your views towards an LSE listing, the advantages of pursuing such a listing?
So we have a fantastic shareholder base in Canada. Like really, the Canadian shareholder base is just wonderful, and they've been great to us. When we've tried to expand our shareholder base to the US, all we receive are questions of how do you compare it to CDW or Insight? When you're having conversations over in Europe, and I've always said I want to sell in a mid-market like Softcat and provide managed services like CanCom, most Americans don't know who Softcat and CanCom are, but European investors definitely do. And they know who Thomas Volk is, and they know what he did with around managed services. So actually, the highest valuations in this space is Softcat out of the UK at 31 times. And when they see me trading at 10 times forward on an EBITDA, when on my growth rate this year, if you add the billion of acquisition revenue, 10% organic growth, and 10% backlog, I'm going to grow my revenues by 70%, my EBITDA by 90%. Last year, I generated 87 million on 93 million of free cash flow and a multiple of 10. Well, when you compare that with Softcat, Cancom, Bekla, Atia, we're ridiculously cheap. And so that's why we want to get over to the London Stock Exchange, is to have conversation with shareholders that have the existing IT service providers in Europe, because we're incredibly cheap compared to them.
Very good. Perhaps I will open it up for questions while we have a few minutes left.
Sure. I have a question. It's Russ Miner. So when you talked about your acquisitions and you've had success and you're in a good position cash-wise now, are you more disciplined than you were before, or are you sticking to the same model, or do you become even, do you scrutinize things more carefully now? I guess basically what I'm asking.
We've always had the exact same process. I evaluate companies by culture, by customer, by geography and capabilities. 28 times, I think we've demonstrated the fact that we are very good buyers. The thing now is we've gotten so large and generate so much cash and have such a strong balance sheet that I don't have to structure them maybe the same way we used to be. So proud of the fact that I didn't require equity on deals. I could fund them with debt and working capital. Now we can pay a little bit more upfront, which might make deal structure easy. And I can pay 5.8 times for PDS and 8 times for Rednet. But the math has never changed in that really valuations are based on growth rate, management teams and cloud services, and 5 is about as low as you can go. We've done some lower, like in the 4s, but we're kind of we're never going to be the high person on price. So we've been always very disciplined on price. And again, the thing about it is I went and met 84 companies back in 2017 and said, when you're ready to join the family, come on board. And that's the thing. People have seen how successful we've been, but how successful the companies we've bought have been. Their salespeople are making more money, selling more capabilities. The engineers get to work on really cool projects in really cool areas. So I think again, these deals are not competitive deals. Most of them are sole sourced, and finance is not the most important part of it because they know our model. Really, it's how we'll treat their people, I think, is the most important thing for them.
Okay, and just as a follow-up, do you get more inbound now calls than you did before?
Yeah. It's our pipeline is crazy. Like we used to only work on 2 deals at a time. Now I have to say it's 8 at a time. I mean, but again, the great part about it is adding Thomas and Doris and Peter so Julianne Beleg, our chief legal officer, who does an amazing job, but the whole team, we're so good at this that we've taken our 4 to 6 a year in North America and added 4 to 6 a year in Europe. We had 9 last year. I mean, it's really impressive how the team is able to go through this and not just buy them, but then integrate, implement the cross-sell, the practice areas. Like we've gotten really good at this.
Okay, thank you. Thank you for that.
Trust.
Hi, Shaun and Thomas. Could you discuss the momentum of Rednet since you acquired it and efforts to expand into additional German provinces, please?
Sure. So I just was fortunate enough finally to travel there because during the pandemic, it's been hard. And so although my German needs a lot of work, it was great to see the people, but they've really defined a new model. And they've organically grown from 3 states to 7 states. And it used to be, so they've convinced funding bodies that it's very important for them to figure out how to use these sorts of funds. It used to be that education was kind of the low guy in the totem pole on funding. The German government has put 5 billion euros to this digital pact to make online teaching accessible to universities and to high schools. And they have this leading model around Azure, but their teacher help desk and this managed end user that has been very successful. So they had over 40% market share in 3 federated states, organically moving to 7 federated states. And then we're buying companies which haven't been announced yet in other federated states that are in adjacent verticals, such as healthcare, that you can use their hands and feet on the street, and they're like they've got this bid desk that goes in against contracts to really grow, and their growth rates are excessive compared to anything else we've got in the industry, and very well funded with a brilliant model with very high margins. So it is definitely, I would have to say, the star of the portfolio in terms of growth. But Thomas, anything you'd add to that?
Well, I think as Shaun said, Rednet has been known as a a very well-established company in Germany serving local governments and education markets in primarily 3 states out of the 16. Right? Germany has 16 states, they were in 3. And they were about to grow now in the next, to grow organically into 7. Right? That's when we entered the game, because they obviously need to accelerate that. They need resources, funding. And that is also obviously something which we look into, whether we can do that inorganically, because that would accelerate their agenda, our overall agenda significantly. The model, as Shaun described it, they applied for the states is really, and I must admit, when I was at CanCom, we couldn't beat them because they were so well entrenched with that model, how they serve, especially the education market, and the closeness they had with understanding what do schools need, what do universities need, what do teachers need, what do students need, what do actually what does the whole infrastructure need, right? And that's where they have created tremendous growth year over year over year, became one of the key players in Germany, and now being part of our company, obviously that opens more doors now for them, for the perspective of first of all becoming having access to more states, adding more resources to it organically and inorganically, but also adding more capabilities. They had some managed services, but now putting them on our managed service platform, automating all of this will make them more efficient, will also allow them to grow faster, and basically help them also to bring the services fastest to new customers. So I think this combination of us and Converge acquiring Rednet is starting to show effect, and I believe during the course of this year and next year, when this money has to be spent in Germany, we'll see that we will get a major portion of that market.
Great, thank you.
Thank you. We did have one question just came through. Is there any risk to the M&A playbook being delayed or impacted from the Eastern European conflict? And then as a follow-on, are European deals getting cheaper?
So we haven't seen it yet. Obviously, this is a much newer thing. We've had some discussions about our shared service center in Eastern Europe. What's the impact to that? But again, as Thomas and I were discussing, really the verticals that we're targeting are in mostly government-funded areas in education and healthcare. And so we don't see the funding and therefore the opportunity or the targets really changing in the short term. But this is all a very new situation. I think that most people in Europe find it quite shocking here, and we're also reacting. But Thomas, any other additional color you'd provide?
No, I agree with you. I think this situation has been changing rapidly in the last 5 to 10 days, right? And obviously that the prices don't drop that quickly, but people are taking a different look at the situation now. And I think it's fair to say that at this point, it is not clear what will happen, what the outcome will be here. So therefore, it's not clear whether people will become more cautious or not. Because, the conflict, while it has it's a horrible situation from a humanitarian point of view. Economically, Russia is not such a big player, right? It is also in the IT space. It is not, that critical. If you look at the GDP of Russia, right, the German GDP is about 2.5 to 3 times larger than the Russian one. The Russian one mainly depends on energy resources, not on IT. So you can immediately see that there is politically a much bigger problem than it is in the technology space. At the same time, our customers, also European mid-market companies, must move forward with their digital strategy, right? They cannot stop and wait. So from that perspective, I don't think that we will see major disruption if the conflict is contained to where it is right now. If it spreads further, we don't know, right? So we never know what the issue we have right now is. It's very hard to predict what's going to happen next week, and I think that's where you see people thinking and whether that has an impact on deals. We don't see it yet, but you never know.
Thank you. And I have another question. Could you discuss the significance of the pan-European approval and how that may change your strategy?
Pan-European approval of deals. So we do need regulatory approval when we're saying buying additional German deals. But say that those are more formalities that you don't really see. The pan-European certification, if that's the question, we expect all of our vendors. So when we created this model for Converge, a lot of the vendors hadn't, getting the new acquisition certified. They don't. Traditionally, people that don't integrate companies, they hate giving them free rebates unless they have the resources to help. Like why they're giving these MDF funds and rebates is because they want knowledgeable people interfacing with the customer. It's all about the customer's user experience. And so the fact that they trust us and that they know we're not just taking the funds and putting it to the bottom line, we're using it in the manner that they want to improve the customer experience, whether it's HP's GreenLake. There will be experts in GreenLake interfacing with the customer for HP, whether it be in Germany or the UK or Benelux or Italy or France. So they'll have that benefit. And that's why the credibility is so important with the vendors so that they trust you to go do that, if that answers the question.
And could you discuss, as you're expanding into Europe and the UK, are there client synergies in that, North American clients who are over in Europe, are the advantages more with the vendors?
So you find that you do have some subsidiaries across, but in the mid-market, they're more likely to be in multiple European countries and less likely to be in North American subs that are there. That's more Fortune 500 and large enterprise stuff. You do see some of it, but it's not as common. And then you especially healthcare and education is definitely very that's more local than say finance or technology, which are our other main verticals. So I think you're seeing mid-market I think has a big impact on that.
And I think what we are seeing, Shaun, is we see several North American customers with business in Europe, which we will be able to serve better. So it has also an impact on North American business. Our Google arrangement is a European and a North American one, which obviously has synergies. And from my experience also in Europe, especially in the UK, we will see several customers who have links into the North American market, which will benefit from us as well. So I think there are synergies there. And I know from the mid-market in Germany, a lot of these mid-market companies have international operations because, that's an export-oriented business, right? So you see them, we will be very attractive for them to work with. I think that's the best.
We've actually run over our allotted time. So I would like to, thank you, Thomas. Thank you, Shaun, very much. I found it very insightful. I really appreciated getting your perspectives on the marketplaces, and really appreciate your being very forthcoming with your investors. As you know, we're extremely bullish on your outlook, and your comments just go further in reinforcing that view. We are here to take any additional questions that we can then forward on to management. But with that, we would like to thank everyone for being on the call and participating.